Okay, welcome everyone. Today we'll be talking about basic financial literacy, and our topic today is investment. We'll be talking about the meaning, the nature, and types of investment. Investment is very important for the fact that it can be used to generate additional income. However, some element of risk are involved in any form of investment, but risks vary from one investment to another. Therefore, the choice of investment is important by the degree of risk involved, but this can be ameliorated with a combination of investment. Okay, you can invest here, invest there, and then you balance out your investment. Today, we will discuss the meaning, as I said earlier, the nature, and the characteristics of investment, as well as the various types of investment that there is. In general terms, therefore, investment involves spending of money with the hope of reaping some financial benefits. To the economists, investment is regarded as savings embarked upon as a result of delayed consumption. All right. And to the finance expert, an investment involves utilization of funds in acquisition of financial assets such as stocks, bonds, uh, real estate, precious items like precious metals, and all that. This holds that practice of investment implies the acquisition of product of financial value with expectation of generating desired returns in the future. All right. The term investment has been described by scholars as something that is acquired with money with the expectation of generating income or profit from it. Authors has defined three basic groups of investment such as ownership investment, lending investment. Well, we'll talk about this later. Now, what are the characteristics of investment? Financial investments should have or exhibit the following characteristics or features. One, earnings. Your financial investment should bring you an earnings. Two, risk of loss. Three, safety of investment. Four, liquidity of investment. Now, let's explain these characteristics a bit. Let's start with earnings. The fundamental purpose of investment is to generate earnings or anticipation of making returns. In respect of financial products, the earnings can come in terms of some interest, capital gain over and above the principal amount invested, and dividends from stocks. Now, the earning from investment can be expressed as earnings, which is equal to prevailing price of stock less original price. Of course, what it simply means is that if you buy a particular stock or article of investment at a particular price, if you deduct the prevailing price from that original price, you will get your earnings. Okay. Now, you bought a car at 2 million and the prevailing price today is 5 million. If you sell it, your earnings will be the difference between 2 million, 5 million, which is 3 million. The essence of investment hinges on expected returns, which may be in form of capital gain or investment. We cannot re-emphasize this enough, all right? Which may be in form of a capital gain or investment income that includes dividends, interest, rental income, among others. Investors normally desire higher return or higher levels of return, but such returns are associated with risk investment. Like they say, the higher the risk, the higher the return. The less the risk, the less the return. Now, another characteristics of investment is the risk of loss. Every investment has an amount of risk inherent. Financial products like government loan, stocks, bonds, treasury bills, and treasury certificates, which are normally floated by government, are known as gilt edge security because of their safety. All right. So financial products of higher net worths, like net worth companies, are regarded as blue chip security of their uh, blue chip security of their yields and higher likelihood of safety. All right. These ones will give you more money. All right. And then they give you more likelihood of safety. Now, the stocks of banks are generally fraught with some risk of loss because of the volatility or the volatile nature of their operations. Therefore, such stocks command affordable prices as they're not that expensive. In comparison, the stocks of oil companies are less risky. They bear less risk of loss because of their stable nature of operation. However, such stocks, particularly of oil majors, command higher prices and higher yields or earning. Investing in debt instruments such as debentures and bonds and so on, what kind of risk of loss do they come with? The risk of loss of investment in this particular kind of instrument is less as a result of their secured operation, while investment in ownership stocks such as financial products like equities or preferred shares, the risk inherent in them is small. So therefore, this is as a result of their unsecured nature and variability of their return and agency problem inherent in the companies. So this some of this concept needs additional explanation, but let's take them first at their face value. As we go on, we'll explain them further. Another characteristics of investment is safety of investment. Security of investment herein refers to the protection or safety of the amount invested and the expected earnings. So security issues is very germane to choice of investment. So you must consider security issues when you make your choice for of investment. While investing, you have to consider the safety of your funds and probability that the expected gains will be earned invariably. All right. So capital gains, for instance, cannot materialize if the capital itself is lost due to mismanagement of the firm's affairs by their managers. So you see this. Fraud or fraudulent practices by staff can also cause the firm for you to lose your capital gain. Things like bad corporate governance, labor unrest, and pilferages in the companies of the company's assets can also lead to such. Now, external factors like economic downturn, volatility in exchange rates, and so on can also be an issue as well in as it concerns safety of investment. And that characteristics of investment is liquidity of investment. Now, liquidity actually means the ease with which an investment can be converted into cash. So the level of liquidity of an investment depends on many factors. The ability of the investor to do so depends on the level of liquidity of the financial asset being held. The financial assets that are very liquid are the marketable securities such as treasury bills or treasury certificate as well as government securities and some more and some extent of stocks and debentures of blue chip chip companies. Now talk about let's talk about types of investment at this point. We have three types of investment. We have one ownership investment, we have lending investment, and we have marketable security investment. Ownership investment revolves around committing your funds in capital market securities such as stocks, buying of shares in companies through public offers or stockbrokers. You go through stockbrokers as dealers in stock exchange, or you subscribe or you go through subscribing to loan stocks of government and corporate bodies. Establishing your own business entity or going into partnership with others to form business entities. Or you are committing your funds in acquiring or acquisition of landed property that ownership of that is ownership of real estate and precious metals and objects. So these, once you are into these things, you know you are into the type of investment called ownership investment. Now, what is stocks? Because let's break down some of these types of ownership of investment. We talked about stocks, we talked about investing in your own business, we talked about derivatives and all that. Let's talk about some of these variables a bit. Now, what are stocks? These are shares purchased as part of ownership of a company. Certificates are normally issued as proof of ownership of such capital market securities. These shares can be equity stocks for ordinary shareholders or preferred shares for preferred treatment for dividends and claims from the business. Now, we also have the concept called derivative. A derivative refers to a financial product which has its value dependent on the outcome of the original financial product as investment uh, as investment by the manager of the fund or funds. Derivative products can be used for ensuring against price movements, such as in the case of hedging, guiding against exposure to price movement for speculation, and as a means of having leeway to some other hybrid assets. or markets. Now, these investable instruments which you can commit your fund into include common derivatives such as options, swaps, futures, and forwards, and collateralized debt obligations, credit default swaps, and so on. All these derivatives are normally traded on a stock exchange or over the counter. Okay, now we also talk about business venture. The money that is used in setting up or starting and running a business is an investment. Of course, it is. It is also an ownership investment with extremely large potential returns. By creating a product or service and selling it to people who want it, entrepreneurs can make huge capitals or huge fortunes from such. Entrepreneurs like Bill Gates, who is the founder of Microsoft and one of the richest men in the world, is a prime example to this in this regard. Now we also have real estate. It's also another options for ownership investment. This involves investing in buying or building houses, apartments, and other landed properties with the purpose of leasing them out. It's also an ownership investment. Why? Such items of investment can be acquired, restructured, and sold. Then we also have precious metals and objects. Some people prefer to cultivate the habit of engaging in the collection and preserving of precious metals like gold, diamond, and objects such as paintings by renowned painters with the intention of reselling them in the future. The intention is to earn profit, of course, from them as their value appreciates. So precious metals and collectibles are not necessarily a good investment option for a number of reasons, but they can be classified as investments nonetheless, right? It is also an ownership investment with its own level of risks. Okay, now let's talk about lending investment. Lending investment. Now, this involves subscribing and investing in debt instruments of corporate entities such as bonds and debentures. These debt investments attract periodic earnings from the interest payment by the companies using the funds to run their operation. The principal amount invested in them is paid back to you after the maturity date has reached. So, investment in debt instruments such as bond debentures is known for relatively low risk when compared to ownership investment stocks and their returns, which is interest, which are fixed. Now, stockholders can incur loss by not getting their money back in the event of the firm being declared bankrupt. Nevertheless, bonds and debenture holders usually get their invested money back in case of insolvency. All right. So let's talk about marketable security investment. Marketable securities refers to money market instruments that are easily convertible to physical cash. There are varieties of these financial instruments in which you can subscribe and invest. Some are called funds being handled by investment companies, all right, while others are usually floated by the Apex Bank, that is our central bank, on behalf of the government. The one being floated by the Apex Bank, that is the central bank, include treasury bills and treasury certificates. So, what is treasury bills? Treasury bills, like we call them T bills, refers to short-term debt obligations that is taken by the government through the Apex Bank. Treasury bills normally has a maturity date of some months, but less than 1 year. It is normally issued by the central bank on behalf of the government to raise funds for meeting shortfalls in revenue with which to finance recurrent government expenditures. All right. Now, treasury bills is a money market financial instrument that is usually denominated in thousands of the country's currency, meant to be purchased in multiples of such denominations. An example can be a denomination of 1,000 in Nigerian currency if issued by the central bank for the Nigerian government. Interest is paid on regular basis till the maturity date, when the principal amount invested on it by the investor is repaid back to them. Let's talk about the treasury securities. Treasury securities are obligations of government. They are issued to cover government budget deficit, that is the excess of expenditures over revenue. All right. and to refinance maturing government debts. All right. The most common are bills, notes, bonds, and so on. Now, treasury bills have original maturity of like 1 year or less, while notes are for 1 year to 10 years, and bonds have maturity greater than 10 years. Okay. Government agency securities. Let's explain what this means. Securities, they are securities issued by an agency of the federal government, particularly in the US, right? Particularly in the US, with implicit backing of the federal government. Repurchase agreements are essentially collateralized loans. A financial institution with large holdings of treasury securities sells some portions of them for a predetermined period of time to obtain liquidity and promises to repurchase the security at the end of that period. On the other side of the transaction is an institution with excess liquidity, right? The amount of the transaction is relatively large and the interest rate is below the federal funds rate. Now, the low rate is justified because the transaction is collateralized by the government security, which makes it a little bit secured. Now, in conclusion, we have provided you with the basic knowledge about investment. We talked about investment essentially being involved in deployment of financial resources towards enhancing a person's income or increasing the level of earnings from investable products in the future. It also connotes acquiring assets with money in the expectation of generating income or profit from them. Inherent in investment are the elements of risk. Therefore, when investing, you have to assess the risk involved in a financial instrument compared to the expected returns before committing your funds. Generally, therefore, consideration in investment includes risk of loss, of investment, expected earnings or returns from investment, safety of the funds invested, and the liquidity in terms of degree of availability of funds when you need the money. All right, that's about it today. We'll be talking about other aspects of the basic financial literacy in our next videos. Thank you. If you have learned from these videos, click the notification button. Please give it a thumbs up so that others can see it or will see it. Always remember to subscribe if you have not done so. Until next time, keep learning.